when aliens invaded Earth. They used their death ray and destroyed one of the companies you own in your stock portfolio. The stock price instantly dived 90%. What could you have done to protect yourself from this situation? The answer is diversification. If you had invested in 500 different companies, the destruction of one company will not set you back because you still have 499 others. Funds are one of the best ways to help you achieve diversification, and one type of fund in particular is much better than others. And to learn more about the different funds, stick around to find out more. Index funds versus ETF versus mutual funds. Index funds, exchange traded funds, ETF for short, and mutual funds, what are the difference between the three? Which is better for you? If you just want a short answer, I will recommend ETF. You can disregard index funds and mutual funds. If you want to know why, stick around to the end for my explanation. Today, we'll look at the differences and similarities between these funds, as well as the benefits and drawbacks. Investors sometimes confuse index funds, ETFs, and mutual funds, despite the fact that they are distinct from one another. So it makes me squirm a little when I hear people use index funds and ETF like they are the same. Index funds and ETF are not the same thing, so please don't make this mistake, and it will be critical that you choose the appropriate one for yourself right away, as changing your mind afterwards may be pricey and inconvenient if you have chosen the wrong one. Now with that out of the way, let us get down to business. To begin, there are many common benefits between these three types of funds. Index funds, ETFs, and mutual funds have similar advantages. The first benefit is convenience, which is offered by all of these funds. Investing in a mutual fund, index fund, or ETF allows you to hold a variety of companies in one simple basket or single stock ticker if they are traded on the exchange. The fund owns many different companies and assets. When you buy shares of the fund, you own a portion of that fund. Since the fund owns many different companies and assets, you own a portion of the fund, and if you own a portion of the fund, you are effectively an indirect owner of all those different assets within the fund. You may be thinking that you can simply directly buy the assets yourself instead of owning through a fund and paying the fees associated with it. And yes, I agree that if you have the ability to buy directly, you should do so and run your own fund. But many investors do not have this ability. If you wanted 1,000 different stocks in your portfolio, you have to buy them one by one. If you spend $10 on each trade, just buying the many different companies will cost you $10,000, and it will take you a very long time. However, depending on the fund you choose, you will either pay nothing or a one-time charge to join. This is a lot easier than having to self-manage a portfolio of 100 different companies and rebalance the weightings on a daily basis. The other key benefit is diversification. Diversification is achieved by owning a variety of different companies. Even if your stock portfolio has 10 separate stocks, if one of them goes down and fail, you might lose a lot of money. If you buy the whole S&P 500 index fund, you will have 500 distinct stocks and companies contributing to your total performance. So it doesn't matter if one of them fails, because you still have 499 others to help you out. This means that if a few individual companies increase or fall in price in the near term, or if one of those companies got destroyed by aliens, it won't have much of an impact on your overall return because you are betting in the long term on the market rising as a whole. Also, as an investor, doing this will provide you with a lot more portfolio stability, because let's face it, most people can't take market volatility, and as soon as they see their price go down, they panic, they freak out and sell, just to see it go back up later on. As a result, investing in index funds, ETFs, and mutual funds address the majority of these concerns. I'll start with mutual funds. Mutual funds were the first to start the funds concept and have been around the longest. A mutual fund is a form of financial instrument in which several investors' money is put together. The fund then goes to work on using the pooled fund to invest into a collection of assets according to the fund's investment objectives. For example, a mutual fund may have the objective to only invest in China. They are not allowed to invest anywhere else. It's important to note that a mutual fund can either be an actively managed or passively managed fund. Passively managed mutual funds are also called index fund by definition, but in the industry, it's widely assumed that when someone mentions mutual fund these days, they are referring to an actively managed fund. For the sake of simplicity, I'll assume mutual funds are actively managed. Actively managed funds. Mutual funds are often actively managed, which implies that a person, usually a fund manager, would actively deploy the pool of investors' money in order to fulfill the fund's investment objective. One of the typical investment objectives is to outperform the market, because if they are actively managed and we are paying higher fees to the fund manager, they should be performing well, right? Unfortunately, that is often not the case. Performance of actively managed funds. S&P published a study in 2019 that compared the performance of actively managed funds to their respective benchmarks. So if we have a fund investing in the US market, we'll compare their performance with the S&P 500 or Dow Jones. If we have a fund investing in the Japan market, we will compare their performance with the Nikkei 225. In this study, it is revealed that contrary to expectations, active managers continue to underperform the market as a whole. For the 9th consecutive year, around 65% of large cap mutual funds underperformed the S&P 500 over a period of 1 year. Some might argue that perhaps it's just bad luck for that year and funds need long time periods to perform. Okay, sure, we give them the benefit of the doubt and stretch the study over longer periods. Let's see what we get. Unfortunately, when we do that, the results are even worse. Over a 15-year span, around 9% of active mutual funds underperform the S&P 500. So if you were to throw a stone at a random mutual fund, chances are that they will underperform. These funds charge an annual fee of 1 to 2% of your account balance each year. If you invest $10,000 in a mutual fund, 200 of it goes directly to the fund manager's pocket. Even if the fund manager makes bad investment decisions and your account balance drops next year, you will still be charged 2%, even if you end up with less money than when you started. The fund manager will be paid millions of dollars for their services. Fees will eat into your account by hundreds and thousands of dollars over time. As a result, the great majority of mutual funds are unlikely to be worth paying that extra 1 to 2%. So you can see actively managed mutual funds are investments that you should avoid. But wait, that's not the worst part. It gets worse. Mutual fund liquidity. Mutual funds are not like stock market shares. They usually have a website where you can sign up for an account and then deposit money directly. This is going to be an opaque process. You see, when you buy stocks on the stock market, they are usually buyers and sellers sitting there waiting for you. The buy price is almost the same as the sell price. The trading is regulated by SEC. Things are fair and transparent there. But when buying mutual funds, it's not as liquid. Buyers and sellers will not be sitting there to provide a market for you to buy into or sell out of. Mutual funds have their own set of rules. As a result, the buy-sell spread is higher. You have to pay higher prices to buy into the fund, and you get lower prices when you sell out of the fund. In order to create an account, they usually have a minimum balance requirement, which makes it more difficult to get started. Sometimes you may have to pay commissions to the bank who referred the business. Due to these issues, coupled with the likelihood of underperformance, I do not recommend mutual funds. Index funds. Let us move on to index funds. Index funds are a form of mutual funds developed in response to a demand for low-cost passive index tracking funds. Index funds, as the name implies, are always passively monitoring an index. An index fund systematically tracks the performance of an index. Indexes, in turn, are used to track the performance of a collection of companies. These companies might be broad-based, like the S&P 500 or Dow Jones Industrial Average. Some are more specialized. They may track only a specific industry or country. So the performance of an index fund shall be tied to the target index to which it's tracking. Since funds perform as well as the index, you will not benefit from any outperformance or suffer from any underperformance. When you opt to utilize an index fund, the management fee is simply paying them to ensure that they match the index as closely as possible, and that's about it. If an index fund is good at following an index, the tracking error should be equal to their management charge. If it's much greater than their management fees, you should definitely reconsider using it because they are not performing what you are paying them to do. Tracking error occur because indexes can change suddenly. When indexes change, the index fund takes time to respond, and this will result in tracking error. Index funds have lower costs than active mutual funds because there is no need to hire highly paid Wall Street analysts to research and pick the stocks. For example, Vanguard's 500 index fund in the United States, one of the most popular index funds in the world and the first ever index fund for individual investors, have a management fee of only 0.04% per annum. This is very low when compared to active funds, which are typically above 1%. The 1% charged by active funds may not look like much, but if you compare to the index fund management fees, it's actually 25 times higher. Passive index funds. Most investors will earn more money investing in an index than they will buying in individual companies on their own. As you've seen from the report mentioned earlier on, over 90% of portfolio managers could not outperform the market index over a 15-year period. So the solution is simply to buy the index and not demand for any outperformance. Keep in mind that these portfolio managers are the best in their professions. These are people who went to Ivy League institutions and have deep understanding of economics and finance. They do this on a daily basis, yet not even they can outperform the market index. And for the ordinary investor, the numbers are much worse. Many investors tend to trade emotionally and worry when the market dips. They panic sell. They also try to time the market, or they jump into a company as it rises for the fear of missing out. These are the reasons why they typically end up with significantly lower than average returns. That's where passive index fund comes to play. Liquidity of index funds. The liquidity of index funds is similar to mutual funds. Although index funds are likely to perform better than mutual funds due to their bad liquidity, I do not recommend index funds. They are much better alternatives, and this brings us to exchange traded fund, or ETF for short. Exchange traded funds, ETFs. ETFs are the newest of these three types of investment funds. As the name implies, an ETF is a fund that allows you to buy shares of their fund directly on the stock exchange rather than through bank transfers. And as you know, anything that is traded on a stock exchange is regulated by SEC. It is more transparent and has better liquidity. ETFs can be passively or actively managed. As you recall, passively managed funds means that they track and copy an index. Actively managed funds means that the fund managers will attempt to analyze stocks and seek out the best stocks which may outperform. Passive index tracking ETFs account for the great majority of ETFs on the stock market. As a result, many people may mistakenly call ETFs and index fund interchangeably. One of the best features about ETFs is that they usually have cheaper management costs than their index fund counterparts. In the United States, the Vanguard S&P 500 fund index fund version has a charge of 0.04% per year, whereas the ETF version has a cost of 0.03% per year. Liquidity of ETFs. As previously stated, ETF trade similarly to stocks. You may purchase one share of an ETF at whatever price it is trading at. When you own a stock of the ETF, you own that portion of the fund. The fund in turn owns a basket of stocks. Unlike index funds, ETFs have no minimum balance requirement as long as you have enough money to buy one share through your broker. Due to this, among the different kinds of fund which I've discussed, I highly recommend passive index tracking ETFs for beginner investors. Agree or disagree with the video? Give a like, subscribe, and leave your comments down below, and I'll see you in the next video.